Hello everyone and welcome to your on-chain update for the 12th of September. So today we're going to do something a little bit different. We're going to be looking at specifically the hodlers or the buyers of last resort. Now the reason that I want to focus on this particular cohort is because ultimately hodlers set the price floor. They put the floor into these markets, and we'll talk about the kind of the movements and the behavior of them as we go. But I want to really dive in and look at specific metrics and just show you my logic and how I play around with these particular charts and specific tools to really understand what this category of holders are doing. So we're going to use a few charts that are on Glassnode, a few charts that are on Check on Chain. But really what we're looking for is to see what the hodlers are doing. What are the people who are here, rain, hail, or shine, buying corn at all times? What is their current market sentiment? And how do we assess that using on-chain data? So we're going to be looking at things like the HODL waves, the RCAP HODL waves, and I'll explain the difference between the two and how you actually interpret them. We'll look at the spent volume age band, which is their spending behavior. Then we'll look at some of these big picture oscillators and kind of macro views in liveliness, reserve risk, and R-HODL ratio. Between these, this is a pretty good tool set. There's a lot of versatility you can get out of it. There's a whole lot more that we can obviously use, but to fit into a typical video update, this is probably a nice little packet of information to start with. So let's start off with our HODL waves and our age bands. We'll talk about these concepts, and really what we're exploring here, the reason I want to focus on the hodlers is after we've seen a very, very large rally off the bottom, we're essentially at a position where it could set up a lower high, right? We're underneath the 200-day. It's not exactly the best place for us to be. However, there's an extraordinarily strong buyer of last resort, price floor, people who stepped in and bought the dip. So I want to explore both that section, why I think that this is actually a hodler's market, why I think supply dynamics are so important. And even though we are underneath the 200-day moving average, I'm still not inclined to move into the bear phase because of just some of these behaviors that I'm seeing. So we're going to explore it in depth, but that's just kind of the backstory on why I want to focus on this today. So to start off, let's just really set the scene looking at our realized price distribution, which is realistically our volume profile. This is looking at the total UTXO set. Where is the current cost basis? Now, just to really set the stage on why hodlers set the floor. So we obviously have all of this trading history that we had down in the, let's call this the pre-history, right? Pre this cycle, we're talking about everything that was under 20,000. These are all the coins that currently exist with a cost basis still down in that pre-history zone. Now, just notice the scale of this, right? This is all 12 years of Bitcoin's life under 20K. This is the amount of volume. You can actually just eyeballing it in, see that there's as much volume up here as down here, potentially more. And we have one, or maybe you could even argue 1, 2, 3, 4 major clusters. Now, this cluster here used to be the largest. If we actually go back and look at some of Glassnode's reports as we were up in that topping zone, this was the largest zone. We had so many coins up here, and the next biggest one was down here. What we saw is as we sold off down to 30, 40,000, we transferred. Many of these coins were sold, transferred down the bottom here, and we've since rallied up. We've also now established a very, very strong level. Now, just be aware that, high level, I don't want to focus too much on directionality here. I think I want to focus on hodlers, but high level, we're at the bottom of this range right now and under the 200-day. That's kind of the bear case for now. But what I want you to really understand is that how many coins have been transitioned from here to have a cost basis up here. So they've been sold by long-term holders to new holders, or they were bought up here at the 50,000, 60,000 range and then sold to stronger hands. Hodlers stepped in and set a new price floor on a significant volume at 30 to 40K and then above 45K to about 50K. So this is what I'm talking about when I say hodlers set the price floor. They have stepped in and essentially formed a new zone where price is going to trade, right? So there's people who believe that it's a value add down here at 30, 40,000. People stepped in serious size and they absorbed all the capitulation potential from $50,000, $60,000 buyers. So there's a huge amount of buying pressure that has come in, and that's why in each cycle, it's very rare for us to go back and revisit the previous all-time high. Because ultimately, there's enough value that people are seeing that hodlers are stepping in and setting a new price floor. And people become accustomed to these new altitudes. And I think most of us, it seems pretty typical and pretty common for a price to now trade up in the 40, 50,000 level. We've become accustomed to it. So hodlers are now stepping in and buying that level. Now, just to set the stage once again, why has my chart shown here? So this is our long and short-term holder profit and loss. So there's going to be 4 different colors on this chart. So what we're looking at here is in the blue is long-term holders, coins older than 5 months. In the red, we're talking about short-term holders that are younger than 5 months. Now, what I really want to highlight here is note how much of the red, meaning coins that were last moved in this last 6 months, note how many of them are now in profit. Note how much this expanded and increased the total amount of coins that will, this is a reflection, and we're talking about 15%. Here's 85%. If we map this across, this is roughly about 15% of the total coin supply was last moved within 5 months and is currently in profit. What does that mean? That's coins that were currently sitting in that consolidation range down there at 30 to 40,000. This is huge. This is hugely bullish. And on top of that, we've got long-term holders who are underwater, right, holding UTXOs up in that top zone who have not sold. And note how we've got short-term holders in profit squeezing in from the top, long-term holders squeezing in from the bottom. That really the people who are currently likely to sell is squeezing, literally the definition of a supply squeeze. Note this same behavior, right? We're looking at the squeezing between this light red and all the other colors. Even you could say light red and light blue. Note how they squeeze, supply squeeze, right? We actually get this squeezing in where everybody's coming into profit and then bang, away we go to all-time highs. We had it again over here in 2019. We had this squeezing of this light red band. Short-term holders, this means that a whole bunch of short-term holders bought the bottom, bought this consolidation range down here when we crashed to 3,000. Huge amount of buyers held. As we rallied away from it, they moved into profit and it squeezed the amount of people who were not long-term holders and were currently at a loss to be smaller and smaller and smaller until the thing just rallied. We had the same effect here. In 2017, at the start of 2017, we had this squeezing in effect where we had the light red really closing in and then bang, we had this massive rally in price. So we're starting to see this same behavior. And this is what I'm saying, long-term holders, hodlers, they set the price floor, they step in, they buy consolidation ranges in size, 15% of supply at this point in time, and then there's just not enough coins there. And eventually we get a supply squeeze. So this is kind of illustrating that it actually looks a bit like a squeeze, right? You get this squeezing in of the light red, until eventually the price just has to pop in one direction. So now let's look at our HODL waves. So the reason I want to start here is this is probably, to be honest, HODL waves are, if anything, probably my favorite tool. Between them and realized cap HODL waves, which I'll talk about shortly. They're just so powerful, so versatile, and you can use it to assess different cohorts within, right? We have long and short-term holders within Glassnode Suite, but you can do a lot with just understanding how old these coins are. Now, bearing in mind that roughly 1.5 months, 2 months ago, 3 months ago, we were consolidating in this range, so we're expecting there to be more of those coins in that 3 to 6 month bracket, right? 1 to 6 is kind of that range. Now, what I want to highlight here is what we've shown is 24 hours, 1 day to 1 week, 1 week to 1 month. So these are talking about pretty fresh coins. These are all within this current rally and then whatever this current pullback looks like. Now, note how we have a downtrend, very, very strong downtrend, particularly in the 1 week to 1 month. Now, because we're showing all of the coins younger than 1 week to 1 month, let's imagine we didn't have 24 hour and 1 day to 1 week on. We see this downtrend. We see this downtrend in these 1 week to 1 month. We don't know whether they're maturing to be more than 1 month or they're being spent to be younger than that. So what I'm now going to do is turn on everything that's younger than it. And because this downtrend is still in play, you can actually see there's a downtrend in the younger band below that. 24-hour coins are kind of this stable baseline. They don't really add too much noise to it. But because everything that's younger than it is still in a downtrend, that means that it's impossible for those coins to be being spent and therefore becoming 24-hour, 1 day, 24-hour, 1 day. We're actually seeing coin maturation. When you see a downtrend in everything that's below it, then that means that essentially the only place that those coins can be going is into an older age bracket. Now, what does coins moving into an older age bracket tell us? So when we have a downtrend in young coins, it's meaning that those older coins are not being spent and coming down into these young bands, aka more hodling, more dormancy, less spending. That's really what you want to see. Now just note where we currently are. This is just under 7%. This is actually the all-time low. We have not seen this level of young coins, the smallest population of young coins. We have not seen this essentially ever. So we've seen a couple of these instances where it pulls back, and almost all of them are in periods where it's just preceding a bull market. Sometimes we get them in bear markets during complacency rallies, which you could argue maybe this is going to be one. But it is interesting to me that we're seeing that we have an all-time low in young coins, and that's really telling us we have an all-time high in coins that are older than 1 month. So that's probably the first observation, is just understanding the dynamics of young and old. Now that we have a baseline, and I generally like to go from young up to old, because I understand obviously the youngest coins are going to inherit all spending. All spending must come down to the youngest cohort and then start aging again. So if we start from the bottom up, or the youngest up, we can say, okay, we know that we have a declining amount of young coins. That's kind of one part of the puzzle solved. Where are those coins now going? So now we can start to, once you've got that baseline, we can start to actually look as we move up the stack. And you can almost do this one age bracket at a time. So 1 month to 3 months, also we have this downtrend. So we saw this fairly substantial uptrend. Now note that this uptrend, we can kind of pick where the peak is. And this was in February. So 3 months before that, which is, sorry, 1 month before that. So you pick whatever the lowest age bracket is. So it takes 1 month at the very least for coins to move into this realm. So we're talking about in February, mid-February. So that means that mid-January, which is essentially just before the Elon pump. So what this is actually showing, this peak up, is showing that a lot of people bought in that just before, in that rally as we moved up towards about 42,000, if I recall, was the peak. And then probably some as we crashed from 42 down to 29. So it's showing that we had a large amount of accumulation on this run up. Now, what we've then seen is that start to decline, right? Now, we also know that over that similar time period, let's just put in our 1 week to 1 month to confirm, over that similar time period, we've essentially seen this downtrend in both of these phases. So we know coins aren't being spent, they're being hodled. So that means that they can only be progressing up to the 3 to 6 month. Let's take off our 1 to 3, and there it is, right? There is that transition at 3 months on, right? We can see that it peaks here, right? Peaks here in March, and then we turn off our 1 to 3, and we can see that this starts to peak in late May, June, July. That's where we're starting to see that 3 month time frame. So from February all the way through to May, June, that's when we start to see the same coins migrating up into older age brackets. Now, once we start getting beyond the 3 to 6 months, this is where we really start talking about long-term holders. These are coins that the longer that they stay dormant, the more likely they are to stay dormant. So once you pass that 5-6 month threshold, we're really talking about coins that have about a 2% chance of being spent on any one particular day. So note that we've got this pretty strong incline, right? These are coins that have essentially accumulated 6 months ago, which in September puts us somewhere it's basically picked up the entirety of the bull market. We're now into April, starting to pick up the topping pattern. So it's going to be interesting to see how this behaves over the next couple of weeks, over the next month or so. But you can see that generally when we get these big spikes in these, call them long-term holder initiation type coins, right? They're just entering that framework. We see these huge spikes in bear markets because essentially people who bought this run up are still in profit, are now holding onto their coins. We generally get these things peak towards the back end of a bear market. Note that this peak towards the back end, right? Kind of the worst is over. You've still got the final capitulation to happen, but we start to see these massive spikes in these long-term holder coins as we near the end of a bear market. And ultimately, this is where a lot of new people who are coming in for the hype and the get-rich-quick scheme, they misunderstand that a bear market is kind of the biggest opportunity that you get, because that's where coins are selling off. But people who are going to stick around are actually accumulating. So really, it's that point of opportunity when you're actually saying, well, these are actually undervalued. Yes, we may have to go through some volatility. Yes, it may take a little bit of time, but patience is generally rewarded for long-term thinkers in any market. But Bitcoin is no different. So once we start moving into what I call older coins, so greater than 1 year, we can see that generally these start to bottom out roughly 6 months or so beyond the actual blow off top. Right, we had our blow off top here. This really started to bottom out. September, when did this peak? December. So 3 to 6 months we started to get this bottoming out in 2014, and then we get this explosive growth. Right, this started to really kick up in November, which roughly is 12 months from the peak. So that shows that there was a huge amount of accumulation. This story here is telling us, particularly in the 1 to 2 years. This is showing us that from that bottom, right, we get a distribution cycle. We get these 1 to 2 years selling, then we get accumulation, and they get this very, very cyclical pattern. Now we're actually going to carry on here to the HODLer ratio to really capture this concept. So this 1 to 2 year, note how cyclical it is. It peaks in bear markets, declines in bull markets. Peaks in bear markets, declines in bull markets. This makes perfect sense, right? Just from a very high level, we're essentially getting a distribution that puts a top in, then we're getting accumulation of cheap coins. Distribution that puts a top in, accumulation of cheap coins, and this system continues to replay. Now, what's the converse side of that? We've got our 1 day to 1 week and our 1 week to 1 month. Now it's turn off our 1 year. Now, this is the exact opposite pattern. They peak during blow off tops, peak during blow off tops, peak during bull markets and blow off tops, peak during bull markets and blow off tops. Why? Because those older coins have been sold and spent, and some other guys come in and go, I'm going to buy that coin. That looks like a great idea. I love this Bitcoin thing. And then they get smoked. This is kind of how markets work. So this concept of the maximum number of young coins versus the number of old coins is the core basis behind what we call the HODL ratio, which Philip Swift came up with. If you don't follow him on Twitter, he's very good at Positive Crypto. He's got a great website called lookintobitcoin.com as well, which has got a whole lot of charts that are kind of similar to what we have in Check on Chain, but his own style. Now, what the HODL ratio does is it takes a ratio between the 1 week or the brand new, right, new people coming in, maximum hype, they normally peak at blow off tops, and the 1 to 2 year RCAP HODL ratio, HODL waves. So we'll come back to what that means in the realized cap, but essentially what he's looking at is when is the maximum number of young coins 1 week versus old coins. When have you had maximum distribution versus brand new hands coming in, weak hands. And what you get is this beautiful oscillator that really picks up, and most oscillators do not pick up this 2013 double pump. They all suggested that was a blow off top, and then we had a second blow off top. This is the only oscillator that I'm aware of that actually picks this up as a non blow off top. So it just really shows, I mean, it's based in that fundamental spending characteristic of the market, but note how we get this beautiful oscillatory behavior. It basically trends between one side and the other. Now, the other thing that I want to just highlight here, so that's kind of the basis for why this is an interesting and useful oscillator. But one thing I want to highlight is note how linear these were. These were kind of just, we bottomed and then we ran. Then we pulled back. Note how we've moved into this stair-stepping type pattern, right? Rally up, stair-step. Rally up, stair-step. This is a really interesting dynamic. This is showing that there's this change in relation or something that's going on, particularly in on-chain behavior. We're getting this change in frequency between longer term and shorter term holders. We're kind of getting these mini bull bear cycles. Now, I actually think that 2017 could have been the last, 2018 maybe, is the last bear market, because this 2019, so a lot of people talk about how the Mt. Gox implosion created this 4-year bull bear cycle. I think 2019 broke us up into a new mini bull, longer consolidation. Mini bull, longer consolidation. And that also really reflects a maturation. Simultaneously, we have institutions coming in. So I almost feel like this has put us onto a new rhythm. And you can actually see this in the change in structure that we have between young coins and old coins that's reflected in this realized HODL ratio. So this is just a really interesting concept. You can clearly see that we have not come up into blow-off top levels. Now, the question is, will this peak be the same as what it was previously? It's hard to tell. We don't really know in advance, but I do just want to highlight that this is an interesting change in structure. And I've been using 2019 as my mini bull, longer consolidation, mini bull, longer consolidation model. And so far, it actually seems to be, in terms of the behavior we're seeing on chain, we're seeing a lot of this play out. Now, what I want to jump to lastly, so that's kind of the HODL waves, which is a proportion of supply in the different age brackets. The realized cap HODL waves is based off a similar concept, but using the realized cap HODL waves. Now, for those of you who know what the realized cap is, it's basically the market cap, but on chain. It maps every coin, multiply every coin in the whole system by the price when it last moved. Now, what the realized cap HODL waves are is it's essentially the same as the HODL waves, except mapped onto the realized cap. Now, the difference is, whereas our HODL waves, let me put all of our metrics back on just so you can see it all. So what the HODL waves is doing is it's looking at all 18.8 million coins and saying, what is the distribution? So on the left-hand axis, we've got 0 to 100%. How much of the existing circulating supply of Bitcoin is in each age bracket? So it's purely supply-based. Note how Satoshi's coins up here, 10 years plus, old miners, 5 to 7. Note how these old coins represent a non-trivial amount of coins, right? They're a fairly substantial sum of the actual 18.8 million supply. However, what was the price when these 10-year-old coins last moved? Basically 0 cents, nothing. So their realized value is very, very small. Conversely, coins that moved down here, these warmer colors, note how 24-hour coins represent a very, very small portion of the actual supply. However, they were last moved at 50,000, 45,000, 60,000. These coins represent much larger value in the network. The realized cap HODL waves captures that concept, whereas the HODL waves is looking at the portion of supply as a factual piece of information. Realized cap HODL waves maps how much value is at each age. How much of the realized cap, you can think about the realized cap as the value stored, is of a particular age. So the other kind of, in terms of practical application of realized cap HODL waves, I like to think about like an accentuated or an exaggerated version of the HODL waves. See how we can't see any of the 10 to 7 years? They're just gone. They represent no value in the system. They're not economically meaningful. Now, if they were spent, they're going to become 24-hour, and note how the 24 hours and the 1 days represent these massive, massive peaks. So what we're essentially seeing is this is capital inflow. When we get these progressive peaks, these uptrends in these younger coins, it's showing that hot money is coming in, fresh capital's coming in, old coins are being spent, revalued at higher prices, and turned into young coins. So the market needs to absorb that. So we get these explosions of young coins, weak hands, new people coming in, but it's showing that there's a swelling of value up at a newer, higher price point. And it kind of relates back to what we were talking about with the realized price, with the bar chart, with the distribution. It's really mapping out how much value is up in these new higher tiers of price levels. Are we seeing the capital inflows come in to really support that? So what we've seen in the current market, previously we saw these kind of multiple waves as hot coins come in, old coins get spent. We get a squeezing of these older coins until eventually those older coins have been hodled, and price rises, and the 1-year-old coins represent a much larger proportion of the total supply, of the total value stored. So it takes time for that value to actually become meaningful because they have to migrate from 1 week to 1 month to 3 months, so on and so forth. Now, what we've seen in the recent market conditions, let's zoom into something like a 6 month. Actually, maybe let's go 2 year, give it a bit of context. Now, what we can see here is a declining value in these younger coins. So less and less of the realized cap is being captured or is held in these hot coins. That's actually because we're seeing, note the belling out, the expansion of this 6 to 12 month band. These are the sailors, right? These are the sailors, the early institutions, the guys who bought this massive rally up to about 42,000. That's their coins getting bigger and bigger and bigger in terms of the value that they represent in the network. Now, what we're going to soon see, right? We saw this consolidation for 3 months, and we know from our relative, from this guy here, that 15% of the supply was accumulated in that zone. Huge amount. So what we're going to see very, very soon is our 1 to 3 and our 3 to 6 month band. This guy is going to start swelling, and then this guy will follow suit, assuming that those coins are hodled. So what we're seeing is that a larger proportion, I would almost cut off from this red zone here, which is our 1 week to 1 month. Once you get above 1 month, we're starting to look at coins that have weathered some volatility. They're more likely to be sticking around, right? People are buying in. If you're looking at 50% drawdowns and you're still buying, you're probably going to stick around. Most of the tourists got wiped out in that 50% sell-off. So a lot of this is pretty high signal. And we can also base that on the fact that the mempool is very clear. There's very few transactions. So the higher probability is everyone who's sticking around is smarter money or a hodler. So what we're seeing is this downtrend in hot coins increasing overall in these older coins, representing more and more and more value. And highly likely we're going to get a second wave of this. So whereas previously, let's go to our 5-year chart, this is a really interesting trend, and actually why I think it makes sense to be a bull. Previously on each rally, we saw more old hands sell to more new hands, right? More hot money, more people exiting. Here we actually have almost the exact opposite reality. We have a rally higher where big hands step in and buy the dip, and they hodl. Then we get a correction. Then they step in so that the hot money sells. then the guys step back in and rebuy during these consolidation periods. We're actually seeing the opposite of this. We're seeing waves of big hands coming in and actually accumulating coins off the market during corrections, which sets up a new stable base. You can see how all of these puzzle pieces are starting to tell us a very interesting story about the level of support that we really have under this market. It looks to me like we actually have on each successive correction very, very large players stepping in, buying the dip and accumulating in these chunks, in these tranches almost. And we're seeing almost the exact opposite of hot coins coming in on each rally as more and more people sell. This to me speaks of Bitcoin becoming a macro asset. It speaks to me of a maturation of this space, that people are actually, institutions are looking for value adds rather than, sure, they'll trade this thing, but it sounds like they're actually looking to buy and add to their positions, same as hodlers, right? A lot of us have been around a lot longer than the institutions, and we're probably doing the same, stepping in and buying these dips because we understand the longer term value proposition here. So this is just a really interesting kind of dynamic I'm seeing playing out. It's kind of the opposite of what we're seeing every other cycle. But for those who are kind of seeing this to me is very, very structurally bullish. Now, we've covered spent volume bands, so that's kind of the hodling behavior. I want to just touch on the spending behavior, and then I want to move to the reserve risk to really close this out into a big picture. Now, what we really want to see here is most of those older coins staying fairly dormant. And you can see that we had this very, very large decline. So the yellow colors are young coins, purple colors are old coins. You can see that we've essentially had this very, very, basically a breakdown, right, where all of the coins that were moving were fairly hot. Higher probabilities that that's actually accumulation. These are coins that were circulating around, liquid supply, big hands are stepping in and actually buying that. And we can also see that we're getting outflows from exchanges. So there's a number of pieces of evidence that are really pointing to the fact that there probably is some strong accumulation going on, has been through here. We know this for a fact. What we're seeing in the current market, a little bit less certain, but still looking pretty positive. We're just not seeing the uptick in these older coins coming back to life. So overall, this is very, very promising. I think that overall our hodler dynamics is extremely strong. I'm quite impressed with it. We still have that downwards momentum on our oscillators that we talked about last week. I think what I really want to focus on here is less about the directionality of the market at the moment, more about just this fundamental basis for how I assess these different tools. So we might leave kind of directionality. We might touch on that in the midweek. But at the moment, the base, the foundation, the structure of this thing looks very, very strong to me. So yes, sure, we could get some volatility in the short term. I'm not exactly excited we're under the 200-day, but when I look at this kind of stuff, I find it very hard to be a bear given this level of hodler dynamics. Now, if this chart in particular, if we get this big explosion of these older coins, let's actually go 5 years because we'll get to see some serious volume come in. Turn off our one, goes to our older coins. So you can see how much volume on a relative basis was spent by these older hands during the actual run-up. Note that we have our capitulation events, right? What we don't want to see is an uptrend, right? Increasing spending as we get more and more grim, right? As this thing sold off, we got more and more spending. We then had these relief rallies and we had more and more spending. We've currently got a structural downtrend in this. So we're seeing less volume being spent as a proportion. Even though we're currently in a, call it a miniature bear market, we're seeing less volume, certainly relative to where we were. But you can see that this is kind of continuing to decline overall. But what we really don't want to see is something like this pick up as price gets weaker, because that would tell us that we're basically seeing the opposite, and we will simultaneously see our hodl waves start to swell from the bottom up. So lastly, what I want to touch on, in check on chain under BTC Realized, we have our reserve risk metric, which is a really interesting one that Hans HODLer put together, who works for Ikigai Fund. You'll find him on Twitter as Hans the Red. You can see his tags up here. Now, between the R-HODL ratio and the reserve risk, these are by far, of all the oscillators, there's lots of oscillators out there, these are my two favorites because they bake in psychology, human psychology, into a very simple oscillator. There's lots of other tools, net unrealized profit and all these things, but these ones, I just really like these ones. I think there's so much fundamentals baked into them. And once you kind of hear the story and you've processed it a little bit, it really shines as a great example of taking on-chain data and really performing some magic with it. So we're going to go through a bit of a journey on how we actually construct reserve risk so you can understand what's going on. So let's start with what you see here is value of coin days destroyed. So let's imagine we know that when a coin, every day, every coin in the supply accumulates 1 coin day. Some of those coin days are destroyed because the coin was spent. Now, some of those coin days, right, if every coin was spent every day, you would have whatever the current market cap is, would essentially be spent every day. Now, what we also know is that over some periods of time, some of those coins remain dormant, some get spent. During bull markets, note how we get this increase in these in the gray bound, and we've also got value of coin days destroyed, which is kind of the dollars assigned to coin days destroyed, and the median value of coin days destroyed. The reason that we take the median is because it smooths out all the exchanges and all that kind of funky stuff that's much higher value. The median kind of smooths out to what's the typical behavior. So note how we have our market cap, or it's converted to price, but let's market cap for a concept. We've got our market cap in black. Off reserve risk. We've got our market cap in black. We've got our value of coin days destroyed, which you can see is quite noisy in the gray, and that's why it's in the background and half shaded. And you can see that we have our median value, which is this red line. Now note how during bear markets, the red line, the median value of coin days destroyed is much lower than the market cap. And conversely, during bull markets, it closes in, and then peaks. During bear markets, we get a separation of the lines. During bull markets, we get a closing in. What's going on here? What we're seeing is that during bear markets, we're seeing less coin days are being destroyed. And that means that every single day that a coin isn't spent, that hodler made the conscious decision not to sell it. So think about that as the opportunity cost. We could all go and sell our Bitcoin right now and cash out at $45,000, and that would be the day, right? You've got a whole bunch of cash, you're done. You've essentially taken the opportunity cost and cashed it in. But every day that you don't spend your coins, you're not cashing in that opportunity cost. Now, why would you do that? Because you believe that price is going to go higher. So when we get during bear markets, we're essentially seeing more dormancy in the system, more accumulation of coin days, more conviction. Conversely, during bull markets, we're seeing people spending their coins, believing that it's overvalued, and as we get to the peak, people generally believe that we're expensive and it's time to cash out. So what we're essentially doing, this difference between the current price, which is the incentive to sell, and the median value that was actually sold, is think about the difference between this red line and this black line is the opportunity cost that was not spent. It's the summation of how convicted the market is to actually hang on to their coins. They could have sold, but they chose not to. That's how we then develop HODL bank. So HODL bank is the cumulative value of this difference. So every single day, there's a difference between the current incentive to sell and the amount that was sold. That difference is the hodling potential. How much opportunity cost was the hodlers decided, I do not want to spend this because I believe it's going higher. Make a cumulative sum of this. So what this HODL bank is now capturing is, as a pricing model, it's essentially picking up how much value have hodlers gone, no, I'm not selling, no, I'm not selling, no, I'm not selling. It's basically a big cumulative sum of hodler conviction. Now, what you'll see is that this accelerates, right, during bear markets because you've got higher conviction to hodl and accumulate. And during bull markets, it really starts to slow down because you've got more of this spending, less of a gap. So essentially what it's providing is it's telling you that you have, during this slow period, you're building a maximum amount of hodler conviction. So what the reserve risk then does is it takes the ratio of price to HODL bank. So what it essentially does, whereas many oscillators, you can see that this has the double pump, both of these picked up as blow off tops, but note how the largest portion, the whole disbelief rally, is in the green zone. What the HODL bank does is it pulls down, it's like a big lever. It pulls down all of this bull market to say this is still undervalued. Only when we start to really accelerate into the final mania phase does it let rip, and then it just trends straight into the red zone. It pulls down note how horizontal, even though this bull market was actually trending higher, note how the HODL bank has actually pulled it down. Because there's so much conviction to hang on, it's actually putting weight on it and pulling this side down towards the green zone. Note how 2019, only briefly did we break above the green zone. It hauled all of this back down all the way through till we almost broke all-time high. This was all considered undervalued. because the HODL bank was showing us that we had a huge gap. The HODL bank was increasing at a much larger rate, so it's hauling down because it's in the bottom of the ratio, hauling down that reserve risk metric. So this is why I really like reserve risk. Note that we're actually getting hauled back down again because we've got this very, very large gap. So even though we're essentially trending higher at the moment, we're kind of up towards all-time highs, 50,000, 45,000. Note that we're actually getting a significant pullback on this is being pulled down. We haven't even come anywhere close to where we were in the reserve risk metric. And that's because we're getting this expansion, right? We're seeing more conviction to hold, adding additional weight, saying, no, this is actually more undervalued than people are taking account of. So that's, I mean, there's a lot in all there in those metrics. But that's a bit of a deep dive on how I, really get in there and dissect what the hodlers are doing, really break it apart and understand what the high conviction, the floor setters, the people who are stepping in to buy this thing when they believe it's undervalued in size, this is what we're seeing. Now, take all of this, again, we can look at all the directionality and leverage and all that kind of stuff in the short term. This is a long-term view. What we're seeing here play out is really, it looks like a bear market in terms of people stepping in and buying the dip. But what we're really seeing in this realized cap hodl waves is kind of this inversion of this previous behavior. So there's just a few tools. It's how I'm using them to really assess and understand what the hodlers are doing. I think the supply dynamics continue to look very strong. Again, we kind of have to see what happens over the next month or two to really pick up all of this recent accumulation behavior and even some of this as it migrates into those higher levels of the hodl waves and the realized cap hodl waves. We kind of want to see whether this hot zone that we've got down the bottom here migrates upwards. We don't want to see spent volume starting to trend higher. These are kind of things to just pay attention to in the short term. But hopefully that provides a bit of an insight into some of these tools, how you can use them and delve into some of the details and just understand what these different parties are actually doing. So thanks for tuning in. As always, if you've got any questions or comments or things, you can always reach me on various channels. But otherwise, I will catch you in the midweek report and we'll do a bit more of a standard overview on directionality and things. Otherwise, enjoy the rest of your weekend and I'll see you later. Cheers.